with Foley and Lardner. So excited that you're here today to join us for our NDI Checkpoint Web Conference, the 2018 Proxy Season Preview. Before we get started, I'm going to give just a minute for our attendees to finalize themselves and get themselves into the room. So just a moment, please, while we get started. Okay, we are going to get started. Thank you for your patience. A couple of housekeeping items before we get going. The first is I'm going to turn it over to our presenters momentarily to introduce themselves, but I'd like to go over just a little bit of housekeeping. Today's program is going to last approximately an hour, followed by a short Q&A session, time permitting. Questions can be entered into the Q&A widget that's open on the left-hand side of your screen. We're going to, again, try to address those at the end of the program, time permitting. If you have any technical difficulties during the presentation, there is a webcast help guide that you can click on the help button below the presentation window. There's a question mark icon there to help. The PowerPoint presentation will be available on Foley.com in the next few days, and you can get a copy of the slides in our resource list widget. From a CLE perspective, we will be applying for continuing legal education credit after the program. To be eligible, you'll need to log in here as you have and answer a polling question that will appear at some point during the program. If you did not supply the CLE information when you registered, you can email me at mbradley@foley.com. Certificates of attendance will be distributed approximately 8 weeks after today's webinar via email. Specifically for those seeking Kansas, New York, or CLE credit, you'll be required to complete the attorney affirmation form in addition to answering the polling question that's going to appear during the program. Like I said, that 5-digit code will be announced at a random moment during today's presentation. You'll need to email the code and the form to, again, Matt Bradley, mbradley@foley.com, immediately following the program. So with that technical stuff out of the way, again, I'd like to turn it over to our presenters for today to make their introductions and get us going. So thank you so much. Megan.
Good afternoon. I'm Megan Odronic, and I'm a partner in the Transactions Practice Group in Foley's Tampa office. I work primarily with public companies on securities law compliance and disclosure requirements and corporate governance issues. We've got a great group of panelists to talk to you today, so I hope you'll enjoy our presentation and find it to be informative. I'd like to ask our other Foley presenter, Kelsey O'Gorman, to introduce herself now.
Hello, everyone. My name is Kelsey O'Gorman, and I'm an associate at Foley in our Milwaukee office. I'm in the Employee Benefits and Executive Compensation group, primarily working on executive compensation matters for public companies. So now I'll turn it over to Zally to introduce herself.
Hi there, I'm Zally Amati. I am the Director for Corporate Governance and Exec Comp at D.F. King. I oversee our strategic advisory team, and I advise my clients on topics like institutional investor policy guidelines, ISS Loose updates, best practice and trends regarding corporate structures and disclosure, and quantitative and qualitative aspects of exec comp programs.
And I'm Peter Kimball. I'm the head of Advisory and Client Services at ISS Corporate Solutions, or ICS as we call it internally. ICS is a subsidiary of Institutional Shareholder Services, the proxy advisory firm. And most of our work involves working with members of the corporate community to help advise them on likely shareholder outcomes, on say and pay proposals, equity plans, governance proposals, and a variety of other matters that go before shareholders. Before joining ISS Corporate Solutions about 5 years ago, I was with the ISS research group that published proxy advisory reports, and before then I was an attorney and economic consultant. So now that you've met the panelists, I think I'll get us started off with a quick look at some of the governance trends that we saw emerge from the 2017 proxy season. There are several worth covering, and I'll start us off by talking about a few of them before handing it over to Zali to go into a little bit more detail about some of them. I want to first call out the second item on this list. Director elections saw a real transition in 2017. Although you don't typically see a lot of uncontested director elections result in very low vote outcomes, the median director support level in the Russell 3000 this year was 98.4%. We did see a number of directors receive less than 80% support that was much higher than we've seen in recent years. Over 2%, almost 2.5%, received what has increasingly become viewed as an outlier level of shareholder support, below 80%. And this is a substantial increase from just barely over 1% that we saw in 2016. In fact, it's the highest level since 2011. And one theory for this is that the advent of mandatory say-on-pay in 2011 shielded some directors in that the presence of this mandatory say-on-pay proposal diverted shareholder opposition regarding especially compensation matters from director election proposals into the say-on-pay proposal. But now that say-on-pay has become the norm and been in place for many years, you're starting to see a move back towards holding not only the say-on-pay proposal to account when there is a compensation issue, but also shareholders are increasingly recommending or voting against directors on the compensation committee. I also want to spend a moment on number 5 on this list. We've seen over the last several years a real and steady march from the use of plurality vote standards, where it really only takes one vote to be elected to the board in an uncontested director election, to a majority vote standard where if there isn't a majority level of support for a particular director, that director is deemed not elected. Now, of course, most state laws allow for holdover directors in that event, so it doesn't automatically kick them off the board. Over 90% of S&P 500 companies, nonetheless, have moved to a majority vote standard with a mandatory director resignation policy. However, we are still at less than 40% of the rest of the companies in the Russell 3000 having moved to majority vote standards. But this is an area where we see more and more companies making the move each year, so I expect a majority of companies in the Russell 3000 to be implementing majority vote standards in the near future. Now, the other items on this list relate to shareholder proposals. Certainly, there's big news in 2017 on climate change, especially 2-degree analysis scenarios, where for the first time we had proposals that received majority support. Proxy access remains an important story as it has since late 2014 when Scott Stringer in the New York City Comptroller's Office decided to make a big push to get companies to adopt what the SEC had hoped to make mandatory back in 2011. And we continue to see a substantial number of political contributions and lobbying proposals, although the support that those proposals see hasn't changed substantially in 2017 from what we saw in 2016. Zally has a lot more material around these and other shareholder proposals, so I'll turn it over to you now.
Sure, I'll pick up the baton from here. What I want to touch on a little bit is this chart that we have on the top 10 shareholder proposals. So we run this chart every year, and it's sort of a way for us to take a bird's eye view of what's going on in terms of the shareholder proposal landscape, what's being submitted, and sort of read into what investors are looking at right now. I think that one of the takeaways that I would say, that I would point out with this is that, you don't really see a lot of change happen year over year in this chart, but 2017 was pretty significant because here you see climate change as number 2 on there. You see environmental and sustainability proposals. You also see gender pay gap, EEO, and board diversity making a splash onto this chart. And that really sort of emphasizes the fact that E&S proposals have taken the spotlight for 2017. And that's something that we feel is going to continue into 2018. But that would be the main takeaway that I would say that we have from the 2017 proxy season. Peter mentioned that proxy access is still up there in terms of submissions. I'll touch a little bit more on that in a second. And again, if you combine the lobbying and political disclosure proposals, that'll take the number 2 spot, and that's generally been in the top 3 over the past few years as well. So not too much change there. Really, the main thing would be that E&S proposals have sort of had their heyday, and it continues to roll into the 2018 proxy season. Now, to touch a little bit on what's going on in your traditional governance proposals, we see a decline in the ones being submitted. And there's a couple different reasons for that, And when I say traditional governance proposals, I'm talking about your adoption of majority voting, your de-staggering the board, sort of your classic good governance principles, eliminating supermajority provisions. One thing is that, best practices are becoming more widely adopted, and that speaks to what Peter was saying about how shareholder rights is really, it's up on the stage as well in terms of what investors are looking for, and companies are responding by adopting a lot of these. So there are fewer companies to target in this arena, and that's one of the reasons. Another is that since a lot of these they're moving from best market practice to current market practice, it's a lot harder to defeat these proposals when they are submitted at a company. The rationales that companies have, for example, for wanting to keep a staggered board just aren't speaking to large investors as much as they had been in the past. So that's another reason that, there seems to be sort of a decline in these proposals and more widespread adoption of the actual governance provisions. And what this means for issuers is that the focus is allowed to sort of shift elsewhere. I mentioned previously that, ESG, E&S proposals are sort of having a heyday moment right now. This has sort of allowed the stage to shift and allow that to happen. Companies that have not adopted the governance best practices, they're fighting it harder and harder to provide effective rationale. And as such, it's happening. They're adopting these best practice principles, and there are fewer proposals being submitted. Now, I will talk about proxy access for a little bit. I know that everybody's a little bit tired of hearing about it, but if you bear with me for just a second, there was a change in 2017 that I do want to touch on with this. So 2017 marked a shift in the type of proxy access proposal that was filed. In the past, we had generally seen proposals calling for the adoption of proxy access. Around late last fall, a lot of our clients had a bit of a spike in blood pressure when there was a round of proposals filed to actually amend pre-adopted proxy access provisions. And what these proposals were really targeting in 2017 were the aggregation limits. Now, what ended up happening is that none of these proposals ended up passing, and there's been no action precedent set with the SEC as well. So sort of a bummer ending for anyone who wanted a little bit of drama there, but at the end of the day, The 3-3-2020 market practice exists. Over half of the S&P have now adopted it, and in general, if Finisher has adopted these provisions, there's sort of a lot of leeway allowed by the larger institutions for the other periphery provisions in a proxy access adoption. What this means now is that momentum has now waned a little bit, has shifted, and one example of that is one of the the original champions of proxy access in New York funds. They've adopted this sort of new board accountability project 2.0, and they're targeting the companies that they had originally targeted with the proxy access campaign. And I think, Peter, you've got a little bit more to share on with this.
That's right. So it's an interesting targeting strategy that rather than going after companies that New York City perceives to have deficiencies in terms of board skills or a variety of board diversity parameters, New York has gone after and sent letters to the 150 or so companies that it had filed proxy access proposals with from 2015 to 2017. These aren't shareholder proposals seeking more information on board skills and diversity, just letters indicating their desire for such disclosure. But by virtue of the fact that New York City has had such success with its proxy access proposals at some of the largest companies out there, and has even provided very granular suggestions for companies in terms of disclosure matrices and the like, companies are taking this engagement very seriously. There are some companies that are likely not engaging with New York City, but many are at least having conversations with them around the kinds of disclosures that would be sufficient. For some companies, the answer can't just simply be disclosure, and it's incumbent upon the nominating committee to gauge its ability or appetite to satisfy the desires that the New York City comptroller has brought to the board's attention. And so we're going to see a variety of outcomes during the 2018 proxy season on this measure. I think we're going to see very few companies adopt exactly what New York City is proposing in terms of a board matrix, but I think we're going to see more moves toward some kind of board matrix and or discussion in the narrative of how the company's board skills and board diversity optimize the board outcomes. So stay tuned for more on that, and we'll certainly be tracking it as we get through the 2018 proxy season.
Now, I'm going to dive in a little bit deeper here on what I mentioned previously, the environmental and social issues that have sort of really emerged into the spotlight in 2017, and detail a little bit more on that. So really, you see almost half of all the proposals that were submitted in 2017, they were related to environmental and social issues, which is, sort of a big sort of shift in what investors are looking at now and what their focus is on. A number of institutions as well have updated their guidelines to reflect this sort of reinforced emphasis in how they're engaging on this and how they're incorporating these issues in their voting platforms. Now, one thing that I did notice is that if you look at these topics sort of on a broader level, you didn't see a huge increase in shareholder support. That didn't speak as much as it did in terms of certain topics within this realm receiving a huge spike in shareholder support. And what I mean by that is, environmental and social issues, that is such a broad term. If you're really going to hone in on two topics that really sort of floated to the top there, you're talking climate change in the environmental sphere, and you're looking at board diversity within the social issues. And those did see, especially with climate change, 3 of those proposals passed, which was a big deal and not anything that we've seen before. And those are really the proposals that we really saw spike in shareholder support there. One question that I'm getting a lot from my clients is, okay, why is this happening now? And the answer there, there have been a couple that have been floating around, but one is, as the current administration, the federal administration does, they decrease environmental regulations going forward. Investors have sort of increased their focus in this regard, and they've made it a clear priority, that this is something that they will hold companies accountable to. And one big event that really helped sort of push this agenda was the withdrawal of the U.S. from the Paris Accords. One interesting thing there is that, within the Paris Accords, really that would require companies to sort of speak to how they limit, the U.S. to speak to how they limit global temperature increase to 2 degrees Celsius. Those are the 3 proposals that passed within the climate change realm, the reporting of companies to talk about how they're limiting, what they're doing to limit that temperature increase. Another reason as to why this is all sort of taking the spotlight now is that the newer generation of decision makers at these institutional investors, they're increasingly socially environmentally minded, and that's sort of seeping its way into the priorities that are being set going forward. Our outlook for 2018, again, investors are increasingly interested in learning what boards are doing in these spheres. And one thing that I will say is that investors have also made it very clear, at least the U.S.-based investors, that this will be an engagement-led focus going forward. There's not going to be sort of any arbitrary threshold set just yet in the U.S. market that companies will be required to adhere to. And so really what it is about right now is this engagement, what companies talking about what they're doing on their end, to focus on these issues and how, and it becomes much more important how that's being translated to their investors. And again, because there's not likely to be a near-term rulemaking decision on climate change, we think that this is going to be something that will continue to gain traction in 2018. Now, again, to talk a little bit more about climate change, another reason why this is a big deal now, almost every large asset manager is a signatory to the PRI, the Principles for Responsible Investment. It's a UN-based initiative, and it requires investors to incorporate sustainability into their investment practices. So it's not going away. Shareholder proposals as well regarding climate change, they're becoming more nuanced and targeted at the more appropriate companies there. And it really allows for institutions to provide a higher level of support. One thing that's really sort of helped this to gain traction as well is the globalization of shareholder bases. European investors, for example, are much more environmentally minded and also socially minded in these regards. And as we see these investors take a larger interest in U.S. companies, we see this being pushed to the forefront as well. One interesting NDI study that I saw recently, they interviewed IR professionals in the U.S. and Europe, and what they saw was about almost 70% of non-U.S. based IR professionals, they incorporate sustainability issues in their engagement outreach versus really less than 40% of U.S. based IR respondents. And we do think that that's going to change going forward, again, because these issues are taking such a strong prevalence in terms of the engagement that's being conducted, but also because the globalization of investor bases is happening. Peter mentioned that climate change proposals won majority support at 3 major energy companies this year. And again, the success in these proposals, what it really comes down to is that the larger institutional investors are changing their positions, incorporating these topics in their decision-making at a much higher rate. And, one thing that I mentioned previously was that a lot of the institutions updated their policy. We're talking BlackRock, Vanguard, and Fidelity, who all updated their guidelines within the past year to address this. And I think one thing that my clients, at least, a lot of issuers that I've heard that are having troubles with at the moment is that there really is, there's a lot of contrasting definitions of materiality by a lot of the ratings providers, the guidelines providers. At what point is a qualitative assessment of an E&S measure, at what point does that affect an economic investment? And there's a problem there, and also in terms of what it is investors want to see. There's no sort of harmonized requirement there. And I think that a lot of issuers are currently grappling with the fact that there are a lot of surveys out there, a lot of different requirements set by different ratings providers, and there's sort of a lack of consensus in what it is everyone is looking for in terms of voluntary sustainability reporting. Now what that means, again, is that engagement sort of takes a more prominent role here, in terms of knowing your investors and knowing what it is that they want to see reported. But I think at the end of the day, this is one of the bigger problems with, this whole topic coming into the realm here, and there sort of being a lack of a reporting requirement there. And I think, Peter, if you want to touch a little bit more on the social side of things here.
Certainly. So board diversity, no surprise, a top governance issue over the past several years, and things continue to escalate, both in terms of outside pressure from shareholders to persuade boards to increase the level of especially gender diversity that those boards possess, but also from the inside, where you're seeing a real revolution in director performance evaluations, moving from surveys to interviews and moving from every few years to every 1 year, which provide a lot more opportunity for directors to give feedback to the board about what's working and what's not, and which direction the board needs to go to oversee the company's operations most effectively. And both of those forces, external and internal, are driving a real sea change in how board diversity looks. One way that we can distill this information is on slide 15, where we take a look at globally the extent to which boards have increased their gender diversity as a way to increase the breadth of experiences and skills and characteristics on their board. May come as little surprise to see that many of the Scandinavian and a couple of other European countries lead the way in terms of board gender diversity. The U.S. and Canada, for that matter, lag. And we can really distill that information into a cross-country comparison here, looking at the largest indexes in each market. There have been a number of shareholder groups pushing for 30% representation of women on boards. And for the first time in 2017, we saw a major stock index achieve that threshold, the Stoxx Europe 600. That does not include the FTSE 350. So the goal has been achieved in some places, but as you look across and you see European and Canadian and Australian and UK indexes, you notice that the United States indexes, the large cap S&P 500 and then the broad Russell 3000 index, excluding the S&P 500 companies, really lag other markets in terms of achievement of more board gender diversity. It's not shown on this slide, but there are more than a quarter of companies in the Russell 3000 that are not also in the S&P 500 that do not have any women on their board. There are only 4 S&P 500 companies that don't have any women on the board. But in terms of achieving a substantial representation of women on the board, there's still a lot of work for these shareholder groups that are focused on the issue and for boards that are sensitive to the issue to work on at U.S. companies. I want to turn to executive compensation. There's been a lot to talk about in 2017 in the compensation realm. And so there are a few themes that jump out from the year that we'll spend some time speaking about here. The first is that after a relatively flat year in 2015, CEO pay at large cap companies jumped. We'll provide more data on that in a moment. A lot of that increase in compensation is attributable to performance-based elements of executive compensation, not just for the CEO, but for other NEOs, even to a greater extent, as companies increasingly, again due to external and internal forces, make the decision to move a greater percentage of executive compensation into compensation elements that are tied directly to the achievement of pre-established and generally rigorous performance goals. Now, of course, that may change based on how the Senate and House tax bills end up in conference, and if there's still, when it's signed into law, if the provision that both of these bills have in them to eliminate the tax exemption for performance-based compensation over $1 million could have a meaningful impact on the way executives are paid, or it could just spur different reasons for the reliance on performance-based compensation. Say and pay frequency was a big topic in 2017 by virtue of the fact that 2017 came 6 years after the initial round of say and pay frequency votes in 2011. And surprising no one, the level of support for annual say and pay proposals jumped substantially. It became the preferred method at 80% of companies back in the day, but now 90%, 91.4% of companies in 2017. So triennial and biennial really are increasingly a thing of the past. We'll be talking about say and pay vote results in a bit with Zali, but the overall point that median outcomes are quite high remains. And in terms of compensation shareholder proposals, there wasn't a ton of action here in the sense that very few received substantial levels of support. First, to CEO pay raises. On slide 19 here, I have the pay raises across industries shown. The median increase was about 6.7%. And you see really substantial differences. It may come not as too much of a surprise to people that the energy sector CEOs did not see substantial increases. In fact, they saw a slight decrease in compensation in 2017 due to challenging industry dynamics. Whereas, technology and consumer durables CEOs at S&P 500 companies did quite well. An interesting one here is utilities. There have been a surprising number of utilities that have had banner years in 2016 and now into 2017. And, the increasing deregulation of utilities markets has been a boon to stock prices and to overall performance at those companies, and compensation has followed suit. Zali's going to walk us through the levels of shareholder support that we saw in 2017 on not only say and pay proposals, but also equity plan proposals.
Sure, and I can be a little bit brief on this just because what we saw this year was, among the highest levels of shareholder support for say and pay over the last 5 years. Less than 1% of companies who didn't receive majority shareholder approval for an equity plan. So really you're seeing a very strong level of shareholder support there. A couple different reasons for this. Over the last few years, engagement has really steadily made its way into especially with regards to topics about executive compensation. This is something that investors are all focused on, and it's something that at least the larger institutional investors, they are all very sophisticated on at this moment. They're not, it is a thing of the past to sort of really just blindly follow any other model, Glass Lewis, ISS, that sort of thing. They all have their own models there, and really a lot of the advisory firm models now are being used as red flag warning systems. So that has helped a lot to increase the shareholder support there. Again, engagement has sort of led to a longer leash here. Peter, I'm going to ask you to just cover your ears for just a second, but we see ISS influence waning a little bit as well, and this again speaks to the increased level of engagement and sophistication that investors are sort of focusing on with how they're addressing SANPay. And that's really interesting as well because we don't see the numbers decreasing. One other thing that I wanted to note was that, over the past 3 years, shareholder proposals regarding exec comp has sort of been on a downward trend there. We were seeing less proposals with regard to pro rata vesting of equity, double trigger proposals, but in 2017 we saw an increase of E&S proposals making their way into the compensation realm. We saw more pay disparity proposals, gender pay equity proposals that have increased as well. And again, to sort of touch on what I mentioned earlier, these proposals are becoming a little bit more sophisticated in who they're targeting and what they're requesting here. So, for example, we see a few of these gender pay disparity proposals at tech companies, for example, or a lot of the mining industry, that sort of thing. I think one other thing that I want to point out, at least on this slide, something that I found interesting was if you look at this SANPay approval chart at this bottom left here, you see this less than 70%, the percentage of companies that receive that. That's an important one to see here. So that's about 6.8% of companies that receive less than 70%. What I found was interesting was one recent survey that I saw was around the same number of companies, around 6 or 7% of companies. That's how many companies incorporate a comp director on their engagement program to their investors. So in the U.S., it's far less prevalent than in the European markets, for example, to include a director on these calls. But again, it's really when you see companies that are having trouble with their SANPay. And, sort of to jump off that topic, I think Peter has a little bit more information about what the most common troubles are with SANPay proposals.
Right. So slide 21 is a dizzying slide, not only because of the amount of content here, but because of the palpitations that some of these items give companies as they consider their 2018 compensation program design. These are the things that tend to lead to the most common concerns from institutional investors and proxy advisors. Every few months, we at ISS Corporate Solutions update this list, which is grouped into 7 broad categories of compensation concerns, but of course really encompasses dozens of potential specific concerns within those categories. And we find it's a good framework for identifying the kinds of issues that are most likely to get companies into hot water with their shareholders when it comes to a SANPay proposal, or in the absence of such a proposal, election of the compensation committee members. We could certainly spend an hour just on this slide alone, but I want to highlight the middle, or the sort of 4th and 5th items, performance metrics and performance goals. These two really have seen the most evolution in the level of scrutiny and the level of sophistication with which shareholders have examined compensation programs. Selection of metrics still tends to be a area of deference. However, where there isn't good disclosure around why a particular metric was used, especially if that metric is a little bit exotic for the industry or unexpected, that's an area that can really cause issues with shareholders. Certainly, there have been concerns for years from a number of institutional investors and ISS research about the use of the same metric in both the short-term incentive program and the long-term incentive program, in that this duplication may incentivize performance in one area at the expense of incentivizing performance in other important areas of the company's financial or market performance profile. Goals, however, really have been the single most important area for a lot of shareholders in the last couple of years. And it's not just enough anymore to talk about what the goals are and show what the outcome against those goals was. Things like the relationship of the current goal to the previous year's goal and actual performance are really important. The presence of any adjustments that were made unexpectedly or towards the end of the performance period rather than those adjustments that were contemplated at the beginning of the performance period, that's an area that gets a lot of companies into trouble. And it's worth pausing there for a moment to keep in mind that when you're writing a CDNA, most governance readers, the folks who are actually going to be digging into the CDNA, are only reading your proxy in terms of gleaning information about not only the compensation and governance decisions you've made, but also about the company in general. Most governance units at institutional investors, unlike their portfolio managers and analysts, are not pouring through the 10K. They're not pouring through quarterly filings or even most 8Ks. They're looking to the proxy for everything. And because 95% of companies use non-GAAP performance metrics, at least somewhere in their incentive programs, it's become increasingly expected that companies will go beyond the simple boilerplate list of the categories of adjustments being made in determining achievement on a particular metric. Rather, shareholders are focused now more than ever on seeing more detail around exactly what is changing by virtue of those adjustments and what impact those adjustments have. Many companies are doing full reconciliation tables from GAAP to non-GAAP metrics as an appendix to their proxy, or even putting them right in the middle of the STI and LTI discussions in the CDNA. And it really has become the biggest source of engagement for companies that have already taken care of a lot of the low-hanging fruit, the issues like excise tax gross-ups and other problematic features of employment agreements and outsized peer group benchmarking that were much more prevalent 5, 6, 7 years ago. With that, I will turn it to Kelsey for a discussion of what may be the other biggest source of engagement, not necessarily with institutional investors, CEO pay ratio.
Great, thanks, Peter. Yes, so as Peter alluded to, next we're going to talk about a little bit about everybody's favorite topic this year, the CEO pay ratio. So this has obviously been a hot topic for 2018, so hopefully everybody knows by now that this rule is going to require publicly traded companies to disclose the ratio of the compensation of their median employee to the compensation of their CEO for full fiscal years beginning after January 1, 2017. So for all of you calendar year issuers out there, this means that you're generally going to have to include this pay ratio disclosure in your 2018 proxy statements. Back in September, the SEC released several new pieces of guidance, which were especially helpful with respect to the treatment of independent contractors, which were discussed at length during the NDI executive exchange that we held back in November. So we're not going to go through the details of that guidance again during this presentation today. However, we have included a summary of that September guidance in the appendix to these slides, which you can download after the presentation if you are interested in learning more about them. And with that, I'm going to turn it back over to Zally, who's going to talk more about her general thoughts with respect to the pay ratio and this first round of disclosures.
Sure. A couple more things on pay ratio here. So some have, a lot of people have speculated that this is going to be a one-year requirement. Both the Choice Act and the Treasury report, they all call for recalls of this. One thing that I will tell, and something that I've been advising a lot of issuers about, is that, keeping in mind that once you put a bit of disclosure into your proxy filing, it's really hard to take that back out without ruffling a few feathers. So what I've been telling, as a lot of my clients is that, to really focus on the process here, try and make it something that can be repeatable and something that's simple and easy to understand for your team members there. And that should really be the focus here. And again, the reason for that is because institutional investors have very vocally come out and stated that they will not be using the pay ratio in 2018 vote-making decisions here. So what it translates to is that this is going to be an employee morale issue, a PR issue, and not as much a sort of institutional investor voting issue for companies here. General consensus on disclosure, and again, this will be refuted by a few, but is that companies should keep this as simple as possible. I know that a lot of issuers have been wondering about how many supplemental charts they should have in this, how many paragraphs of additional disclosure to sort of explain what's going on here. But again, guidance from SEC can be translated to relax. As long as companies exercise good faith, they will not bring enforcement actions. And again, from institutions, it translates to this is not going to be a problem for us this coming year. So again, PR issue, employee morale issue, and focusing on keeping this process as simple as possible is really sort of key here. And I think, Kelsey, if you want to take it over and talk about the CLE. Oh, Matt.
Thank you. Sorry, this is Matt Bradley from Foley again to transition from CEO to CLE for just a second for our participants on the line. I'm going to now open up a poll. You should see it present on your screen. I'm going to read aloud the CLE code for this program. So if you're looking for continuing legal education credit for this program, stand by here. I'm going to announce a code that will ask you to write into the to the screen there and press that submit button. I'll leave it open for just a minute here so that everyone can do that. The code is SQYQM. So to reiterate again, the code is SQYQM. And I'm going to say it one more time at the end, but let me just reiterate, if you're seeking credit for this session, we're going to ask you to complete that polling question that I just announced the code for. If you're seeking it in Kansas, New York, or New Jersey, in addition to the question, I'm going to need you to complete the attorney affirmation form and return it after the program. A copy of that form is found in the resource list widget. So as a reminder, again, the certificates will go out approximately 8 weeks after the webinar program. One more time, the CLE code is SQYQM. Thank you for your time here. Pardon the interruption, and we'll get back to the program.
Thanks, Matt. So I want to spend a few minutes on what to expect from the proxy advisors in terms of policy updates for the 2018 proxy season. I'm going to start by looking at ISS policy updates and then turn to Glass Lewis. And within ISS, we're going to start with governance policy updates. The first one is poison pills. This affects a couple of hundred companies that have long-term pills that were adopted sometime after early 2018. I'm sorry, 2008. And where ISS is really ratcheting its approach to holding directors accountable for the presence of long-term poison pills that have not been approved by shareholders, where instead of going against annually elected boards every 3 years, ISS will be going against them every 1 year. And there will be no more grandfathering of the oldest poison pills as they had been grandfathered under the previous policy. For short-term pills, which of course pills are on the wane these days, and most pills are short-term pills in existence for a few months up to a year or so, ISS will keep its case-by-case analysis, but instead of focusing on the track record of good governance at the company, its primary focus in evaluating whether to recommend that shareholders support directors who unilaterally adopt a short-term poison pill will focus on the rationale for adoption of that pill. Is there a specific threat that the company or an activist has disclosed that requires the presence in the board's discretion of a short-term poison pill. There were a number of other governance policy updates from ISS for 2018. Some of these are just codifications of existing approaches like pledging and SPAC extension proposals, and ISS's approach towards companies that fail to opt out of state laws that mandate classified boards, which, by the way, right now only affects about a dozen Indiana companies and one or two Iowa companies. However, there were a couple of updates that are new. One is a nomenclature update primarily. Instead of the ISS director independence categorizations being insider, affiliated outsider, and outsider, the terms will now be executive director, non-executive, non-independent director, and independent director. There was some shuffling around of particular independence items between these three categories. However, the overall approach to evaluating whether someone is independent or not, it remains the same. And there was actually a policy that got more lenient from ISS this year in that directors who join a board during a fiscal year and who only serve on that board for a portion of that year will not be subject to the attendance policy because presumably those directors did not have their schedules aligned with those of the company upon joining. Compensation is really the area where we're seeing a lot of movement in the ISS policy approaches, especially with regard to the quantitative screening that ISS conducts as the first phase of its pay for performance evaluation. Worth keeping in mind, of course, that in addition to a pay for performance evaluation, ISS also conducts an evaluation of any problematic pay practices that may come from employment agreements, severance plans, or other sources, and where responsiveness is a concern, i.e. where a SAN pay proposal got less than 70% support, there's also a responsiveness evaluation. So pay for performance isn't the only story of ISS's SAN pay evaluation, but it is the biggest. It is the one that drives the most negative recommendations, and so changes there matter to a lot of companies. What's changing is that there's going to be a new element of the quantitative screening from ISS, a look at the alignment between CEO pay and financial performance. For those of you familiar with the ISS quantitative screening in its current form, the new FPA or financial performance alignment test will look a lot like the relative degree of alignment or RDA test that exists on a TSR basis. All three of the existing TSR-based tests will remain and comprise the initial screen, where that initial screen is a medium concern or a low concern that is very close to a medium concern. The financial performance alignment test will determine whether that company ends up with a final low concern on the quantitative screening or a medium concern. So where financial performance is strong, and there's a strong linkage between financial performance and CEO compensation, that will serve as a mitigator for companies where the alignment between pay and TSR performance may not be as strong. And conversely, it is possible that for some companies, the presence of the financial performance alignment test will exacerbate concerns that were relatively mild with regard to a comparison of CEO pay and TSR-based performance metrics. Many companies, in fact most companies, won't see any impact from the financial performance alignment test because 3/4 of companies get a low concern, and only a portion of those companies will be close enough to a medium concern to subject themselves to the financial performance alignment test. And of course, if you have a high concern on the initial TSR-based tests, financial performance alignment won't help you. So all of this, of course, is just a starting point for the ISS research team's qualitative evaluation, where someone actually goes in and reads the CD&A and executive compensation tables and makes a determination as to whether the why behind the what, right, the disclosure of the decision-making process and the rationales for the elements of the company's compensation programs and other compensation decisions is reasonable. And that's what drives vote recommendations, not this quantitative screening. That said, of course, it's a very closely watched test that many companies are starting to focus on this time of year, both with regard to their 2017 compensation and as they design 2018 compensation. There are a couple of other things changing with regard to the quantitative screening. One is that ISS is modifying its TSR calculation slightly. Instead of point-to-point comparisons from December 31 at the beginning of a period to December 31 at the end of a period, ISS is going to take month averaging. So the idea here is to smooth the starting and end points a bit to avoid the volatility that comes from using one closing stock price. So you'll see month averaging of TSR used in the relative degree of alignment and the pay TSR alignment tests. When it comes to director pay, there's not much changing right now. ISS announced that starting in 2019, it will focus on a few companies, outliers, that have a pattern of persistent, excessive director compensation practices and pay levels. I wouldn't expect this policy to affect very many companies, but it is it is an important thing to consider whether it's going to impact your company based on your director pay relative to peers and others in the industry. ISS is also taking a look at say and pay frequency and holding companies to task where they fail to put say and pay frequency on the ballot when they should. There were a few dozen companies that failed to put it on in 2017, at least originally. Many filed an amended proxy to do so. There were probably only between 100 and 200 say and pay frequency proposals expected in 2018. Either from new IPOs or companies that had their first one in 2012. So if they fail to put it on, or if they fail to adopt the frequency that shareholders most supported, and of course that affects companies that had their say and pay frequency proposals in 2017, then that will play a role in director election recommendations. There are some tweaks to equity plan scorecard. There are no policy updates. These changes occur below the policy level, but S&P 500 companies will need 55 points instead of 53 points on equity plan scorecard to receive a favorable recommendation on their equity plan share authorization proposal from ISS. And there are a number of tweaks to the way in which ISS is scoring certain plan features and grant practices. Really, from ISS, there are two shareholder proposal policy updates. One relates to the climate change proposals that Zali and I covered at the top of the hour, where ISS is now no longer simply focusing on whether a company has identified risks to the company from a possible 2-degree rise in global temperatures, but also on what the board and management are doing to manage, monitor, and mitigate those risks in determining whether to support a shareholder proposal seeking more disclosure around climate change impacts. And there have been some proposals in recent years, about a dozen, a little bit more in 2017 on gender pay gap. This is not executive or director gender pay gap. This is rank and file company-wide gender pay gap that some shareholders are seeking more disclosure on. And ISS will take a case-by-case approach here as it has in the past, but the policy is a new one in that it's making its way into the policy documents for the first time and examining a variety of controversy and disclosure-based elements in determining whether to support these proposals. Some updates from Glass Lewis include a significant one relating to board gender diversity for the United States. Starting in 2019, Glass Lewis will recommend against the chair of a nominating committee of any board that has no female directors, where there is also no disclosure around actions that the board and nominating committee are taking to eliminate that concern by adding female directors in the future. So again, starting in 2019, but that's a big one, especially for the quarter of companies outside the S&P 500, but in the Russell 3000 that have no women on the board at present. There's also a big shift in what Glass Lewis is doing with regard to board responsiveness. It will now be required to get 80% support on a director election proposal or a compensation proposal, and to get at least 80% support on those kinds of proposals in order to avoid a responsiveness evaluation. Glass Lewis's approach for Sam Pay had been 75%, and its approach for director elections had been well below this 80% level as well. It's still kind of operating in the fringe in that only about 4% of directors fail to receive 80% support, but it is a big change that will affect the way a lot of companies focus their get out the vote campaigns and indeed focus their disclosures to avoid that level of support. And finally, there were a few other Glass Lewis policy updates as well. The most wide-ranging one here is that starting in 2019, Glass Lewis will recommend against companies that hold virtual-only shareholder meetings, unless those companies clearly disclose that shareholders will have the same rights to participate at those virtual-only meetings that they would at a physical meeting. There's been a real proliferation of the virtual-only meeting phenomenon in the last several years. Went from about 10 in 2010 to about 150 in 2017. So we're expecting that Glass Lewis will, by virtue of this policy update, influence some additional disclosure around the rights of shareholders at virtual meetings. That concludes the quick tour through ISS and Glass Lewis policy updates. I'll turn it back to Megan now for the final portion of our event.
Peter, thank you. It's actually Matt. I'm going to step in real quick. I know we're slightly over time, but there was a few questions about the clarity of the CLE question, so I'm going to reopen that question. You should see it now on your screen, and I'll reiterate the code. So folks who might have typed it in wrong, they'll have a chance to get it right here. I'm sorry if it was a little bit jarbled. It is S as in Sam, S as in Sam, Q, Y, Q, M. And we'll leave that open for just a second so people might be able to remedy that real quick, and then I will throw it back to Megan. Let me just say also at the conclusion of this program, a questionnaire is going to appear on your screen. Please take a minute or two, if you could, to give your feedback on today's presentation. It's important to us to know your thoughts, and it helps us shape our programs going forward. So strongly encourage you to take a moment to do that. If you've got any questions regarding the program, CLE, or content, you can always contact me again at mbradley@foley.com. Okay, I'm going to throw it back to Megan. Sorry.
Hi. Well, it looks like we did not have any questions posted during our discussion, so I think we're at a point and a little over time, so we'll go ahead and wrap it up for the day. But we just wanted to say thank you very much to Peter and Zali for all of their great slides and all the great information they shared with us today. We really appreciate it. And of course, thank you to all of the folks who signed into the webinar to join us today. We really appreciate it, and look forward to hearing from you all in our next webinar. Thank you.